record, so we'll be recording this session. We actually end up having more people attend our recorded versions of our webinars than not because people just happen to be at lunch and in meetings and things like that. Turn on my webcam here so you can see me for right now. But the one thing that I've noticed is that we've got a lot of people watching the recordings afterwards. So please continue to pass on those links to other people that you know and care about and maybe should have been on the webinar. I actually had one of my clients tell me this week that when we do webinars, he actually gathers people around his desk at lunchtime and they all just watch while they eat their lunch. So that's fine too. I love teaching. That's one of the things that I got from my dad, actually, is that he was a high school chemistry teacher for years and years, 30-some years, until he retired from that. And so I got that love of teaching and also the love of business from him because he was also a salesman for a feed company in Iowa. And believe it or not, he actually is hitting his 50th year. There's not many people who make it 50 years at a company, but he actually is coming up on that. So very proud of my dad and proud that he was able to pass those loves on to me as well. So with that being said, I'm going to get started. I'll take myself off of the screen here in a moment, but the one thing I do want to point out is that Keystone is a little bit different in that we're actually a fiduciary. And sometimes people haven't heard that term before, or they might have heard it thrown around in the news, but they're not quite sure what it actually means. What fiduciary is, it means that you've got a trusted advisor that actually has a legal obligation to give you advice that's in your best interest first, which you might say, well, duh, that's what a financial advisor should be doing. But the reality is, in our industry, in the U.S. at least, somebody that calls themselves a financial advisor or a financial planner is not necessarily a fiduciary. So it's very confusing to consumers. I can tell you that I am proudly a fiduciary advisor and have been for many, many years. So Keystone Financial Services has that standard of care for its clients. We're not only giving you advice that's in your best interest, but we're required to disclose things like costs and where your money is invested and where you can see things. So very important. I know a lot of our clients take that for granted, but at all firms, they don't necessarily get that. So we love it because we get to wow people when they move from another firm to us because it's a big, big step up for most people from what they have normally experienced. So today we're going to talk about the investment process. I will take myself off right now so you can just see the slides. But what you'll notice is that I've got that CFP after my name, or Certified Financial Planner. That means that we give advice that's comprehensive and not just on investments, not just about retirement planning. We can cover any area of money that somebody has in their life. So that might be retirement planning, employee benefits, estate planning, Social Security, Medicare, helping kids out with different things like college education. Those are the fun parts about our job because everybody's story is a little bit different. Everybody's story is a little bit unique. And we have the honor of being able to walk alongside our clients as they go through a lot of different stuff in their life. So that being said, we'll get started on the presentation today. It's the investment process, and we actually haven't talked about investment process before in a webinar format. And we've had this request really from people trying to understand really how do you start an investment process? How do you guys do it there at Keystone? And really, is it just taken for granted, or is it something that's important that I need to be looking at for myself and my own planning? So we're going to dig into a couple of things. Keys to investment success, I can tell you number one is investor behavior. And you may have seen this before or heard from various sources, Morningstar and Cowen and Dalbar. There's a bunch of different companies that have done studies on investor behavior. And the reason why that's so important is that returns for people who get caught up in the crazy cycle, that means people who are buying high and selling low, their returns are really bad over time. And I know we can sit here and say, well, why would you do that? That doesn't make any sense. It's because at the top of the market cycle, people get greedy. People don't want to miss out. And so they take on more and more risk. And then when the market collapses and goes way down, then those same investors want to run for the hills and sell all their stuff that they just bought at high prices. So it doesn't make any sense, but it is emotions that will drive people if they don't have something or someone like us to tell them not to do that. So we don't want to buy high and get greedy. We also don't want to sell low and be fearful. And that's really the opposite of what you want to do. In fact, I think it was Buffett that said you want to buy when others are fearful and you want to sell when others are greedy. and that would be the exact opposite of normal investor behavior. So that's a big part of investment success, the biggest part of investment success. And then another thing is being adhered to a process and not just winging it. And I'd say that most people, even if they can keep their emotions in check, they tend to be just winging it with their own investments. They don't really have a disciplined process, and they're probably either reacting emotionally or they're reacting based off of what their neighbor or their coworker said or what the media says. God forbid, you don't want to be watching that and watching CNBC and things like that and making your investment decisions, because remember, the media is not your friend. Media is there to sell ads. That's their business. And they don't sell ads by telling you good news or telling you what you should be doing as an investor. What if the media was reporting what we have on the screen right now, and what they're reporting is, hey, investment success is based off of your behavior and your emotions and adhering to a process over time? How long would people watch? Probably not very long. It's a lot more exciting to talk about the news of the day and politics and the things that happen just that day instead of talking about a long-term process. Really, that's where good results are going to come from. Good outcomes are going to come from people who have those in the mix. So let's talk about the investment process. Number one is goal setting. Goal setting is pretty important because that's really where we establish our objective from the beginning, right? Make sure that we're headed in the right direction and know what the money is for to begin with. Why are we investing in the first place? You would be surprised at how often people don't take that step. They don't really evaluate what the money is for. So oftentimes the rest of this doesn't get done correctly because it's all, again, just winging it. Step two is portfolio construction, then based off of the goals. Very important to base them off of the goals. Then the portfolio is constructed. Things are implemented, taking action, of course, and then finally portfolio monitoring and evaluation. So goal setting. Pretty important to think through really what is the money for? What's your current financial status? Our job really is to figure out where you are now and help you determine where are you today. And that might be taken for granted by a lot of people, but I see literally over my career, I've seen thousands of people, thousands of meetings with clients, and so often people don't understand their current financial status. They don't understand where all their money is. They don't understand how much risk they're taking. They also don't understand really what they don't know, right? There's a lot of things that they don't know about their employee benefits or maybe some things that their spouse is even spending money on or putting money away. So it's pretty important to really establish that baseline and get organized at the beginning so we really can at least establish where we are today. Then setting long-term goals and objectives. Short-term goals are important too. Could be paying for a wedding or a vehicle or maybe just a vacation, right? Just normal kind of spending stuff that we want to do. But very important when we're thinking about investments to think about the long-term stuff, because really I would say pretty strongly to anybody who is thinking about putting money in the market or anything with risk involved in it, that if you've got less than a couple of years until you're going to need that money, that's probably not the right thing to do. You probably want to have that money in the bank or in an investment that's pretty darn safe and liquid. So really, when we're talking about investments, we're talking about the long run. Goals such as being financially independent, being able to retire, not having to work, being able to pass on a legacy to kids or grandkids, be able to help with somebody's college education, or maybe it's funding some dream goals like being able to travel and see certain places of the world or experience certain things. So pretty important that that's well defined, and we want to make those goals smart, of course. We've heard that before many times, but making sure that all those goals are very specific, measurable, achievable, realistic, and time sensitive. So understanding time horizon is important, very, very critical to think about what is the money for. Two totally different objectives. For example, college education funding. When is that money going to be used? It depends on when the kid's going to go to school, but when is it going to get used? It's going to be very quick. In other words, all that money is going to be drawn out of the accounts within 4 or 5 years, hopefully, if they get through in that period of time. But thinking about college, it's all going to come out pretty quickly. So that money would be invested very differently probably than somebody who is retiring and might have a good 30, 40 years left to live and be spending that money. And then what is your tolerance for risk? Understanding really what are you going to be comfortable with from a turbulence standpoint. And I say turbulence simply because most market risk really is just turbulence. Very few times do people permanently lose money in investments if they hang on to them over time, as long as they started out in a diversified way. So the market really is not that bad for people who have time horizon. For people who have a very short time horizon, they can get hurt because they can get forced to sell those investments at an inopportune time. So very important to understand the time and understand how much money somebody is willing to lose. That basically is risk tolerance, is how much money are you willing to lose, even if those are temporary losses. And turbulence is not deadly to airplanes, and it's not to individuals as well. So we shouldn't be averse to risk necessarily. We just need to understand what we're comfortable with. So portfolio construction, there's a fancy term in our world called asset allocation. And what asset allocation is, in the simplest term, is that we've got our money in more than one bucket. And those buckets, I would call them either security bucket or risk bucket, or security bucket or growth bucket, if you want to call it that, a little bit friendlier than saying risk. But basically, the security bucket is made up of things that aren't going to go down in value very much. They don't jump up and down very much, but they're probably also not going to get as great of a return. The growth bucket is going to be something that can actually outpace inflation and will be much more volatile and much less certain, but that's where we're going to get our growth from over time. So very important to think about which areas we want to be allocated in. Those broad categories would tend to be things like stocks, real estate, bonds, cash, sometimes alternative investments that could include real estate investment trusts, for example, or other alternative investments that could fall in different areas of the economy. Contrasting that with investment selection. So once we've got our asset allocation set, asset allocation is the first key and will come up after we stop behaving badly. Number one, we talked about that before, as we don't want to get on that crazy cycle where we're constantly buying high and selling low. So the next most important decision is figuring out how much do we have in our security bucket or our growth bucket. And once we determine that, of course, now we need to fill out those buckets, figure out what are the specific things that go in those security buckets and growth buckets. That would equal portfolio. And portfolio is one of those things that people throw around, and sometimes people don't even know what it means, but a portfolio is simply a collection of investments, probably in various types of accounts, in different tax statuses, things like traditional IRAs, 401ks, Roth IRAs, annuities, things like that people might own. Those would all be part of somebody's portfolio. So that's one thing that I really like to focus on is thinking about not just a portfolio in terms of individual investments, but going back up to that 30,000-foot view and thinking about really what was the money intended for to begin with. And the reason why is that it's really all about life, right? The reason why this money was put into place was not because you enjoyed investing. Most people don't enjoy parting with their money, even if it's only temporary, but people part with it because they realize that they've got a future and they've got something to plan for. So monitoring that over time is pretty critical because really there's all kinds of stuff that happens. And in the early part of my career, I would come across people that they would come in to my office and they maybe met with another financial advisor or planner. They'd come in with this big, beautiful leather-bound financial plan, and we'd start looking at it. And one of my first questions is, when was the last time you looked at this? And more often than not, the last time they looked at it was in the financial advisor or planner's office when it was delivered. So I tell you that simply because there's a big difference between a financial plan and financial planning. We don't really do a financial plan. We do financial planning here at Keystone because life happens. You can see on the screen here, obviously, a lot of different stuff happens in people's lives: marriage, divorce, birth of a child or a grandchild, for example. That's the fun stuff. Divorce isn't fun, believe me. But going through all this stuff, it's the fun part for us as financial advisors is that everything changes. Every single day, people's lives change, the market changes, the economy changes, and of course, we've got politics that will throw a wrench in all of this stuff, right? So it's interesting to look at things in terms of a portfolio, but it's also important to remember what is this money for to begin with. The reason why anybody, whether it's a corporation or an individual, puts together a portfolio is because they want to produce income. They either want current income or they want future income for something else to be able to fund something else, again, such as a retirement income or college education. But that's why anybody invests in anything, is that they are looking for either current income or future income. So let's break things down a little bit as far as what investing means and some different styles of investing. So active portfolio management, people might define this differently. So I'm going to spend some time talking about what it means to me and what it means to our clients. Active portfolio management tends to mean that we're using some type of portfolio manager that's actually doing the individual security selection. In other words, they're going in and making changes based on what they're seeing at different companies or in the economy. For example, they might be buying Apple and selling Samsung and buying Walmart and different things in that portfolio. But it's definitely an active process in that they're not just going with what the market's doing. They're going with their own insights, their own research. They would tend to be employed by a big company like a Fidelity or Oppenheimer funds. Those will be companies that would tend to have actively managed mutual funds. The second one that you see there is passive investment management. And passive investment management tends to be a buy and hold type investment strategy, which would tend to be index funds. So an index fund would just buy a collection of stocks that would match up with some type of an index. The most common is the S&P 500. It's simply taking the 500 companies in the Standard & Poor's 500. They are weighted by market capitalization. And the reason why that's the case is that the biggest companies, for example, Apple would be one of the largest components in the S&P 500, would have a much bigger impact on somebody's return if they owned that index. And the smallest company, which I'm not even sure what that is, but the smallest company in the S&P 500 would have the smallest impact. So as those stocks move, Apple or the biggest company would have a much bigger impact than the smallest. Indexes are not designed the same. Some are modeled after commodities. For example, you can buy a gold index fund. Other terminology here, by the way, is ETF or exchange traded fund. If you're wondering what the correlation here is, it's that index funds and ETFs are very similar in that they're just tracking an index of something, whether it be bonds, stocks, real estate, gold, something like that. But it would tend to be something that within that investment vehicle, at least, it's not being actively traded. There's no human involvement, in other words, as far as changes to those securities. And number three, another term to think about is technical analysis, and that would be a little bit different than those first two. And technical analysis is somebody or an organization who believes that they can put together quantitative models, meaning that they're putting together something that is trying to catch patterns in securities or markets and be able to time things, essentially. And so it's not actively looking at individual companies like Apple or something like that and saying, well, gosh, they just came out with a new iPhone and their sales are going to do this or that. They don't care. A technical analyst doesn't look at that stuff. What they look at is they look at trends, they look at charts and graphs, and they try to come up with different things that they think are going to happen based off of that quantitative analysis. So the question that you might ask is there an advantage? Well, let's keep going and we'll talk. Fundamental analysis, that would tend to be where you do go in and you individually analyze those securities. And so a fundamental analyst would be somebody who doesn't care about the trends. They're much more focused on the individual companies. Concentration versus diversification. Concentration would be, at its worst, of course, would be putting all the money in one company. And we run across this a lot with our clients because we primarily work with clients in the high-tech world. And oftentimes those employees get a lot of stock awards. They get restricted stock grants, stock options. They may have an advantage to participate in a stock purchase plan. So oftentimes what ends up happening is that they accumulate a lot of their own company's stock and they get overly concentrated. That's not necessarily a bad thing if your company does well, but of course the trade-off is that you can get absolutely killed financially when things go down, and we've seen that happen with companies as well. Worst case scenario is that an actual company goes broke and somebody loses all of their money, and we know people from 2002, 2003 that were employees of Enron, for example, And the rules changed after that too, because it used to be that not only could you own your own company's stock, but you could use all of your 401k funds to buy your company's stock. In some cases, companies actually required it, that their employees owned a certain percentage of their 401k in the company's stock. Therefore, a lot of people that worked for Enron and other companies, we can use other examples, but a lot of people that worked for those companies that lost literally everything. They lost all their investments. So concentration at its worst would be a single security. Diversification, of course, would be putting your eggs in a lot of different baskets. Instead of owning one stock, why not own 500, S&P 500? Or instead of just owning the S&P 500, what if we owned the S&P 500 and we also owned a small company index and a mid-sized company index and an international index and a bond index and a real estate index? What if we wanted to cover the entire market by owning lots of different types of funds? And then buy-sell discipline, that's pretty important to think about because it's a lot harder to sell a stock than it is to buy a stock. If you and I went through right now and we made a list of all the best companies that we could think of, it really wouldn't be that hard. You could think of some really good quality companies that are growing or are very, very stable, and we could buy them and they might do really, really well. The trick is knowing when to sell them, though, and really that's why it's so important to have some objective eyes and some really skilled eyes that can analyze securities and know, without getting emotional about it, they can know when to get out. Emotions are, again, we will go back to that again and again. Emotions are the biggest thing that sinks people when it comes to their portfolio, is they get their emotions involved and they have some regret because they didn't sell before. This is kind of how it goes, is that, gosh, I wish I would have sold before. Now it's down 10% in value. Now I can't possibly sell. And then it goes down another 5%. And, oh, gosh, I should have sold before. And it goes down another 5%. I should have sold before. On the upside, a lot of times people will hang on to a stock because they just think it's going to keep going up and up. And they allow themselves to get overly concentrated. So it's super important to have a sell discipline. Buy discipline is important, too, to make sure you're not overpaying for stocks or buying bad companies or bad investments. But very, very important to have a sell discipline to know when to get out. So what factors should you consider when you're putting together your own process or analyzing an advisor's process if you're working with someone? So you want a process that's repeatable. First of all, it needs to be something that can be done over and over again. It's not just luck. It's not just winging it. And it needs to be able to be explained. You should be able to write it down, in other words, and somebody else should be able to take that same strategy and be able to repeat it. It needs to be research-driven. Certainly, it needs to be based off of something that has been researched and thought out and tested. It shouldn't be something that is just somebody's whim that they think that a certain strategy might do well, or they might take a single factor that tells them that a certain area of the economy or a certain company is going to do really well. Also should be focused on identifying high-quality, well-managed companies. Of course, want to be looking at companies that have good management, that they're quality, not only from a financial standpoint, but they've got a sustainable business model. They've got something that isn't just the business that they are today, but they've got a plan for how are they going to become the business of tomorrow. Many, many companies, of course, we could think of right now that don't exist or are going downhill because they didn't have that second piece. They didn't have a clear direction or the correct direction of that future company. They didn't get it right, in other words, and so they just get passed by. And then, of course, looking at secular trends, what we mean by that is simply looking at, where's the interest rate environment and where are demographics? Where are people moving? What are people spending money on? Do we have people that are aging that might be spending money in different areas? So looking at that, certainly looking at politics, looking at the direction of legislation, all of these things can have a significant impact on people's investments. Construct personalized allocations that should be tailored to individuals. What we're not looking for in the investment process is something that's just a cookie cutter. An investment process should be something that's thought out based off of that individual, what they need and what they want, not just based off of what everybody else might want, or just coming up with a strategy just for marketing purposes that makes it easy to sell to people. What we tend to see some strategies out there called target date funds or retirement date funds, oftentimes in people's 401ks. And although they can get some decent results, they're really meant to be a cookie cutter. They're meant to be for people who don't want to look at their money at all. They don't want to look at their investments. They want some type of a default option. And sometimes that works out fine. But what I can tell you is it's not customized. It's not really aligned to that person's needs. And so it's not well thought out. It's not something that really should be, it's not the best way, I guess, is the whole point. And certainly communication, regular meetings, either with yourself. If you're self-directing your investments, you do want to have regular checkups with yourself, or if you've got an advisor, you need to be holding them accountable. They need to be producing results, and they need to be communicating with you in a way that you can understand and that really identifies your needs. So it's important that you're checking up on things individually. You want to evaluate the portfolio, and they need to be doing that in between too, even if it's not something that you're meeting with them. They need to be watching the portfolio and making adjustments. It's nice if you've got somebody who's got discretionary authority within parameters, right? But the discretionary authority on the portfolios, because that gives them the ability to be able to make adjustments instead of having to call all their clients. You can just imagine that would not be at all practical or timely. So you want to make sure that it is evaluated and watched on a nonstop basis. Recommendations should be proactive. Should not just be you calling your advisor, your planner, or your investment manager. That should not just be you calling them. They should be calling you or be proactively recommending and anticipating the things that you haven't thought of. I think that's the best way to think of it, is that they really should be uncovering things that you wouldn't have on your own. They should be able to help you see things that you don't see. And that's the advantage of having a coach. And in our case, that's really what we do. In a lot of cases, we act as the financial coach, where we are able to help people see their life, their goals, where they are, where we're seeing the economy, and help them uncover stuff and make changes based off of that they wouldn't have done on their own. That's a huge part of the value. Trade notifications, of course, you should be informed about what's going on. It should not be some black box where you can't see where your portfolio is. And then, of course, along with that comes transparency. There should never be a question in your mind as to how much you're paying, how your money is invested, how much risk there is, any other transaction fees that are associated with it. So all of that should be completely transparent where you can see it, and not just in your advisor's office. It needs to be able to be something that you can access on your own, again, because of that accountability. So putting it all together, really the investment process will tie into your investment experience by tying into your goals and tying into your advisor. All that needs to be integrated. It needs to be something that you're not doing it all on your own, and you've got somebody that you can trust, that you've got a fiduciary, you've got somebody that's looking out for your best interest, that understands what you want, they understand where you are, and they're skilled enough to be able to know where to go in the future. Expected returns and plan development, expected returns and plan development. There really should be some metrics in place so you know what to expect. You should have a process that allows you to go in and see what your returns would be expected to be based off of lots of different types of environments. But really, there should be some expectations set. And then the plan development is important because the plan actually will take into account all your goals, your life, and all the things that you want to accomplish individually. Wealth management strategy selection, really that's where it comes down to what goes in those buckets. Which strategy are we using? Are we using fundamental analysis, technical analysis? There's no right or wrong. I'll tell you that I'm not going to get religious about this. There's no right or wrong when it comes to investments. Really what it comes down to is having a disciplined process that will be followed and not jumping around. So making sure that it's well thought out and that it meets your expectations. Transparency, again, extremely important. Our industry has not been very good about this over time. So having transparency from your investment advisor, planner, you should be able to see all your investments, your performance, your fees. That should all be very, very transparent to you, and it should not just be discussed in the meetings. It should be able to be something that you can access through technology or some other means whenever you want to, because it's very important when you're paying somebody and you're trusting somebody to be your fiduciary that they're not just doing stuff and you're not involved. It's extremely important that there's an integrated collaborative process that is between you and your advisor, and it's not something you're just doing on your own or they're just doing on your own. There's discussion, and it's well thought out. So with that in mind, any questions that you've got, certainly I don't see any in the queue right now, but any questions that you've got, feel free to pass those by me by my email address at josh@keystonefinancial.org. That's the best way to get in touch with me and get a response quickly. One thing that I'll also mention is that some people wonder, how do I know if my advisor is a fiduciary? And the surefire way to know is, other than asking, because a lot of people will say they're a fiduciary even though they're not, the one surefire way is to make sure that they're a CFP, they're certified financial planner. If they're a CFP, they're a fiduciary. They're required to uphold those standards, and having those letters after someone's name doesn't guarantee anything, but it does tell you that they are a fiduciary. They do have that status. Also making sure that they are charging fees as opposed to commissions. If you're paying a fee, it's a lot easier to be transparent because it's probably just being deducted from an account, or you're being invoiced where you can see it. So then you'll know exactly what it is that you're paying. And obviously it's up to you to figure out, am I getting the value that I expected from my advisor or planner? If you're not, then that's where we want to talk to you. Certainly, we want to be that backup quarterback. If you're super happy, scale of 1 to 10, if you know that your advisor is a 10, then that's great. We would encourage you to stay with them and have a great relationship. But if it's not at a 10, or if you're doing it yourself, or you're maybe just with your employer's benefits and haven't thought about really what you want to do for your investment strategy, that's where I would love to visit with you. My team would love to visit with you and see if we could add enough value that would make sense for you to make a change proactively for your future. I hope all is well with you. Take care, and if there's anything that comes up, certainly let us know. We're honored to be able to serve in this capacity, and we're looking forward to seeing you soon. Contact information, again, josh@keystonefinancial.org. My phone number, 970-744-5408. We always love feedback, and we love to see our clients at events, and we love to see them on our webinars. Also, feel free to pass on the recorded version, which we will get out shortly, and you can pass it on to coworkers, friends, family, anybody that you think that this will be valuable for. Thank you. Talk to you soon.